Good evening, everyone. I'm Larry Kudlow. Welcome back to the Kudlow Report, where we still believe free market capitalism is the best path to prosperity. All right, folks, first up tonight, we've got some breaking news on the status of the big Washington tax deal. Let's go right to CNBC's John Harwood, live at the White House. Hello, John.
Larry, it's all sales all the time. The negotiating's over. It's been a double-barreled effort here at the White House today. Larry Summers, David Axelrod, and Robert Gibbs came into the briefing room a while ago. Larry Summers, the outgoing head of the National Economic Council, warned of the heightened risk of a double-dip recession if this passage doesn't pass. Then this evening, Vice President Biden went to the Hill to try to sell the package to House Democrats who are angry about the deal the president's cut. Now, the feedback I got from inside that room, the members didn't go to the cameras, but I got some to talk to me via email. The word that I got was that Biden was good, candid, and forceful in that meeting. He made a positive impression on the members, but they do not have a whip count. I can tell you, Larry, I think it is highly likely that this package is going to pass the House. The Republican caucus is fairly well united behind it. But the question is, do you get a critical mass of Democrats to get them over the top? I think they'll get there, but they got to work this way through for the next few days. Senate's going to vote before the House, probably early next week.
John, one quick follow-up on the other side of the Senate chamber and the other side of the aisle. Senator Jim DeMint came out against the thing. Do you put much creds on that? What does that mean, if anything?
I think Jim DeMint is not going to be able to stop a deal that Mitch McConnell has negotiated in the Senate. I think there will be enough Democrats and Republicans come together to pass it, and it will strengthen Jim DeMint among the Tea Party members, but isolate him to some degree from leadership in the Senate right now. And
one last one, John. Coming back to the House story today, Larry Summers, I'd gotten wind of that. He said if we don't get this tax deal through, there's going to be a double-dip recession. Do you know? No, just to be clear, he didn't say there's going to be a double dip. He said the risk of double dip goes up if we don't get this package. All right, the risk goes up. So now is Vice President Biden using that? The risk goes up of a double dip recession. What I was told that Vice President Biden has been saying in the meeting, I understand that you don't like some of these deals, and we don't either on estate tax and on the top end, but this deal is as good as we can get through the Congress right now, and we need it to get this economy going again. All right, John Harwood in Washington, thank you very, very much. Now, folks, let's go back to topic A tonight, which includes tax cuts, but it also includes Treasury rates, King Dollar, and rising stocks. And we have a rare interview with special guest Howard Lutnick. He's the CEO of Cantor Fitzgerald and its publicly traded arm BGC Partners. Mr. Lutnick's firm was decimated in the 9/11 World Trade Center attack, and his growing successes in rebuilding the firm is one of the great comebacks in American finance. At least that is my honest take. But first, let's talk about higher Treasury bond yields with our very own bond yield, Rick Santelli, live from Chicago as always. Hello, Rick.
Hello, Larry. And indeed, if you're looking at yields, they have moved up rather aggressively of late. You can look at an intraday chart and note that 10-year note, which was auctioned today, not a bad auction, tomorrow's 30 years, is that it touched 332. But it didn't settle up there, but a 6-month chart reveals these are 6-month highs. What does it all mean? There's a lot of reasons. I'm sure Larry and I will get more into it in a minute. If you look at the yield curve, though, this is where a lot of the street's trading, and there's some mixed messages. 10s minus 2 is one of Larry's favorites. Yeah, it's steepened rather dramatically. But look at the difference and contrast that with 30s minus 10s. That was at 160. Now it's under 120. Breathtaking flattening going on that part of the curve. As, of course, we notice that the 10-year made up for ground with regard to its relative value on the yield curve against 30s. Now let's look at some other important areas. Larry likes King Dollar. Look at this 1-month chart. Listen, maybe we're looking at a dollar over the past year that is higher, but let's be real here. Most of that is from the bounce that occurred in early November. That was a 9% bounce. Of late, seems like it's trading in a range. Now let's get to the nitty-gritty. $50, say goodbye over 2 days, and I'm rounding on gold. Look at this 2-day chart, so dramatic. In silver, about $2.50 vaporized in 2 quick sessions as well, as precious metals contend with lots of things, whether it's China potentially tightening or, as my theory goes, higher interest rates aren't kind to sterile commodities. Larry?
Well, Rick Santelli, let's go there. Higher interest rates, unkind to commodities. I basically agree with that. I want to say I have a logic. I want to test it on you before I get to my panel because you're you. I say tax cuts mean stronger economic growth. Therefore, Treasury rates are normalizing higher. That is also good for the dollar. Lower taxes and better growth. All that works for stocks as well. I see a new trade here. I'm going to call it a king dollar, better economic growth trade for stocks.
Well, the only thing I disagree with, Larry, is that, yes, we had some cuts that weren't just extending what the tax rate was. See, in my opinion, I never encountered any traders the last several months that didn't think that ultimately these tax structures would be nullified. So they thought that the taxes would remain at the current levels. So if that's the thinking of some of the bigger traders out there, what's really changed? Certainly it's a better thing than not doing it, but I think we have to moderate expectations a bit. I like supply side. I think it's a good thing, but really nothing has changed from a month ago to a month down the road. They did sprinkle in some other incentives, and I think all that is good. But at the end of the day, there are still a lot of structural issues. You know, 90% of the people are working, parts of the economy are growing, but I'm one of those that think 9.5% unemployment is going to have a half-life that's quite long.
Well, you may be right. Perhaps in our lifetime, Rick Santelli, we will actually see a real live spending cut in our lifetime. Such a thing is possible. Rick Santelli, thank you ever so much. Now let's get some reaction to all this: higher bond rates, a stronger dollar, plunging gold and silver, and a rising stock market. All right, is the market at a turning point for investment strategy? There is a new mix here. Sitting next to me is a dear old friend and very special guest for us. He's the chairman and CEO of Veneral Investment Bank, Cantor Fitzgerald. He's also the chairman and CEO of interdealer broker BGC Partners. I'm, of course, referring to the indefatigable Howard Lutnick. Welcome back to the show.
Great to see you.
Great to see you. Now, also with us is Joe Battipaglia, market strategist, Stifel Nicolaus, and Todd Schoenberger, managing director, Land Cult Trading. Howard, start with you. First of all, can a strong dollar coexist with rising stocks? And second of all, is a stronger economy from tax cuts or whatever behind it all?
Well, I think I disagreed with the last comment, which is I think everybody was expecting Obama to raise taxes on everybody, maybe, you know, a few bits and pieces of the middle class, and they were all counting on it. So this is actually a change. I think that's why you saw bonds, right, 25 basis points since they said it. So you see higher interest rates in the bond market, not necessarily coming from the Fed, just coming from the world. Fed's trying to go the other way, having no success. You're going to get a stronger dollar, and they're pushing us to stocks. So pushing us to stocks.
Just one last one on this. Year on year, 52 weeks ago, the dollar is up 5%. And stocks, of course, are up whatever they're up, 10 or 12%. Can stocks rise with, let's say, a firm dollar? Not an exploding dollar, but even a stable king dollar. Can stocks rise with that?
Absolutely, absolutely. It's a very simple back to math. The dollar's going to rise as interest rates rise, right? Because if you're sitting there with your money, where are you going to put it? You know, you were comparing the euro to the dollar. Now you're saying, hey, interest rates in America are higher. It's better to just leave the money in the dollar. So the dollar's stronger, but a tax cut, as you said, is going to help the economy. I thought it was a surprise. It's going to help the economy. It moved it. I think the economy is looking positive about that.
All right, well said. Joe Battipaglia, I want to get your reaction to what the great Howard Lutnick has just said.
Well, the problem is that the market's responding to the fact that the Federal Reserve cut its growth estimates and is applying quantitative easing well into the new year to June. You not only now have the tax rate staying the same, but you now have additional stimulus being brought to bear as the old stimulus runs off. So my question is simply this: an economy that needs all of this assistance from the monetary authority and the fiscal authority cannot be strong on its own merits. And clearly, with unemployment higher, not lower than where we've been, and economic growth half of where we were a year ago in the fourth quarter, the question does remain, what kind of economy do you really have? The dollar is up simply for the fact that the euro is going down because of the sovereign debt crisis. So on balance, the private sector is improving. but this is the 17th month of supposed recovery, and we're not seeing growth in jobs, and we're not seeing accelerating economic activity. We're seeing a flat line move sideways that requires the Fed and the federal government to apply more stimulus.
Well, Todd Schoenberger, economists are now marking up their 2011 economic growth forecast by, I don't know, a half a percentage point or maybe more. Almost everybody's in the 3% zone. Todd, what are the odds that we don't need QE2, $600 billion pump priming money creation, or that it may be trimmed over time?
Very low, Larry, because we definitely need a QE2. And as a matter of fact, we're probably going to need QE3, just taking what Joe just said. Look, this is completely manufactured. It's false growth that's occurring with the economy. You have a 2.5% GDP rate right now, but I'm sure the argument can be made that a lot of that was brought on by the wealth effect brought on by the Fed from what their actions have been. So then you start incorporating the Bush tax cuts being extended. That can only help as far as sentiment, as far as improving that wealth effect, and it will help equities down the road.
So why are you so bearish on the economy? Why do you think we need all this Fed stimulus? Why not be prudent, pull back? The Fed's like a hedge fund. Their holdings of treasuries are about to get pounded, whack-a-mole into the ground as bond prices fall and rates go up. We're going to have to bail out the Federal Reserve.
That's right, Larry, but when you start thinking about everything, the reason why I'm bearish on the economy right now is because there's nothing organic about it. Everything that is happening right now is based on the Fed's actions. You could see that from all the talk from out of the Jackson Hole meeting in August all the way up until November 3rd with the launch of QE2. The wealth effect really took place. People were spending money again. You even had corporations reporting dynamite earnings during that time. 83% of companies beat on the bottom line at that point. So when I start looking at all of that, that's great, but still, when you look at a 9.8% unemployment rate...
Maybe you shouldn't obsess about that. Maybe that's a lagging indicator. Let me ask Howard.
And by the way, he's not getting what he's looking for, Larry. If he wanted to get falling interest rates, he's not getting it.
No.
If he wanted to knock the dollar down, he's not getting it. He did get the stock market higher. So that's not a winning formula. And then he had the audacity on Sunday night to say, well, if it's not working by June, I'll just do more of it. That assumes that he's got the right answer. I'm not so sure the markets think that he is the right answer here. And the Republicans coming in the majority in January may challenge his hegemony over all that's financial.
This could be good. This could be good. The Fed often has the wrong answer, and I have to change your view. But Howard Lutnick, what do you make of these two very distinguished economic pessimistas?
Well, I think, look, the Fed's QE2 is throwing money to what? They're saying, let's cut interest rates in the 7-year. And what's just happened? For the last month when they announced it, interest rates have gone up 1%. So they have not accomplished anything with their money. They're trying, but it's going nowhere.
So the market is more powerful than the Fed.
The market is really big, and they're just trying. You know, they were saying, gee, if it needed a little push, we'll push. The stock market can rise because where the heck else are we doing money? That's what the Fed's doing. They're saying, you got money at 1%, 0.5%, 2-year notes at 0.62. You know what you're going to buy? You're going to start to buy stocks. So stocks are going to go up. They're not going to boom up. The economy's not going to boom up. It's all sort of melting upward.
Sell gold and silver. Sell gold and silver and buy stocks?
Absolutely. When interest rates are zero, you know, gold and silver, artwork, diamonds, they're all good. You know, you start putting interest rates on all these things, then, you know, art on the wall, diamonds on fingers, you know, gold and silver, 1,400 gold and silver, challenge. I think interest rates up, gold down.
Joe B., what do you think of that trade? Rates up, gold down, stocks up. What do you think of that trade, Joe?
Well, here's the problem. Rates up and energy prices up, economy fumbles both here and abroad, and suddenly the earnings picture starts to deteriorate, and all the excitement that we've enjoyed from the profit recovery dissipates. And now what do you've got? No growth, high unemployment, not a very big growth rate on the profit side, and stocks can move sideways. So you've got a negative scenario that could come out of this because the real economy can't support the enthusiasm the stock market has taken from being ginned up by the Federal Reserve activity.
All right, Todd Schoenberger, I'm going to give you the last word. Even though you're leaning on the pessimistic side, you're telling us to buy stocks. What's your favorite investment strategy, real quick?
You definitely want to buy stocks. You can look at the multinationals, despite what's happening in Europe right now. I still like the blue chip companies, obviously the consumer discretionary companies right now, because when I start thinking about the wealth effect being impacted for investors and consumers, I think that people will be heading to the malls and will be shopping again. So I love those sectors right now. But back to one thing what Joe said, though.
I got to leave it there. I got to leave it there. You'll get a chance to critique Joe another time. I appreciate it. Joe Battipaglia, Todd Schoenberger, thank you very much. Howard Lutnick's going to stick around to talk about his remarkable recovery from the 9/11